For decades, the United States financial system has been built on structures that most Americans never question. Banks, credit cards, loans, salaries, savings accounts, and retirement plans have all followed the same basic framework for generations. But quietly, beneath the surface, that framework is beginning to change. Not slowly, not temporarily, but permanently. Most people won't notice it until it affects their paycheck, their savings, or their ability to build wealth. By the time it becomes obvious, the system will already be different. This is not a theory. It is already happening. To understand why the U.S. financial system is changing forever, we must first understand how it worked for so long, and why that model is no longer sustainable. For most of modern American history, financial stability followed a simple formula. Work hard, earn a steady income, save consistently, invest conservatively, and retire comfortably. The system rewarded predictability. Wages grew steadily. Housing was affordable relative to income. Debt was manageable. That model began breaking down long before most people noticed. Inflation slowly eroded purchasing power. Wages stopped keeping pace with productivity. Housing prices disconnected from salaries. Education costs exploded. Healthcare became one of the largest financial burdens for families. Yet the system continued operating as if nothing had changed. Banks still offered low-interest savings accounts. Credit cards filled the gap between income and expenses. Debt quietly replaced wage growth as the primary financial cushion. For a while, this illusion worked. But illusions depend on confidence, and confidence is fragile. The 2008 financial crisis was the first major crack. It exposed how deeply interconnected and fragile the system had become. Trust in banks collapsed. Millions lost homes, savings, and jobs. The response was unprecedented. Massive money creation, near-zero interest rates, and long-term dependence on cheap debt. This emergency solution became permanent policy. For over a decade, the U.S. financial system relied on easy money to function. Asset prices rose, stock markets surged, real estate boomed. On paper, the economy looked strong, but beneath that growth was imbalance. Low interest rates punished savers and rewarded debt. Asset owners benefited, while wage earners fell behind. Wealth concentrated at the top, not because of productivity, but because of access to capital. This created a silent divide. Two financial systems emerged, one for those who owned assets and one for those who depended on wages. Then came a second shock. The pandemic didn't create financial instability. It accelerated it. Trillions of dollars were injected into the economy in record time. Temporary relief became structural dependence. Inflation followed. Suddenly, everyday Americans felt what numbers on charts had been hiding for years. Groceries, rent, fuel, and insurance costs rose faster than paychecks. Savings lost value. Credit card balances grew. The traditional tools stopped working. Saving felt pointless. Debt became expensive. Stability felt unreachable. This is where the system begins to change. When trust erodes, alternatives emerge. Technology has introduced options that did not exist in previous generations. Digital payments, mobile banking, automation, artificial intelligence, and blockchain systems have started reshaping how money moves. Not as a replacement, but as a parallel system. The U.S. financial system is no longer centralized in the way it once was. Banks still exist, but they no longer control every transaction. Fintech platforms process payments faster than traditional rails. Investment access is no longer limited to institutions. Most importantly, money itself is becoming programmable. This shift is subtle but powerful. Instead of relying entirely on human-controlled institutions, financial logic is increasingly embedded in software. Payments execute automatically. Contracts enforce themselves. Systems operate 24/7 without manual approval. This is not about cryptocurrency hype. It is about efficiency. The same forces that transformed communication, transportation, and commerce are now transforming finance. The difference is scale. Finance touches everything. The U.S. financial system is changing because it must. The old model depends on assumptions that no longer hold. Stable wages, affordable living, predictable growth, and endless trust. A system built on debt cannot expand forever without consequences. As pressure increases, new mechanisms emerge, not to destroy the system, but to adapt it. Some Americans will benefit from this transition, others will struggle. The difference will not be intelligence, it will be awareness. Understanding what is changing and why is the first step toward navigating the future. Because the system is not waiting for permission. It is already moving. And this is only the beginning. At the center of this transformation is technology. For over a century, banks were the unquestioned gatekeepers of money. They decided who could open accounts, who could get loans, how fast payments moved, and how expensive financial access would be. Their power came from control over infrastructure. That control is weakening, not because banks are failing, but because technology has removed their monopoly on financial movement. Today, money no longer needs to wait for banking hours. Payments do not require human approval. Transfers can happen instantly across borders without traditional intermediaries. This shift is not ideological, it is operational. Efficiency always wins in the long run. Fintech companies were the first signal. Mobile banking apps began offering faster onboarding, cleaner interfaces, and better user experience than traditional banks. Peer-to-peer payment systems replaced checks. Online brokerages removed commission fees. These changes seemed small at first, but they trained Americans to expect speed, simplicity, and control. Traditional banks responded slowly, constrained by legacy systems, regulation, and outdated infrastructure. Their core systems were never designed for real-time global digital finance. Technology exposed that weakness. Then came automation. Algorithms now make credit decisions, manage portfolios, detect fraud, and route transactions faster than human systems ever could. Artificial intelligence analyzes risk patterns that traditional underwriting models miss. This has reshaped financial decision-making. Creditworthiness is no longer evaluated only through static metrics. Payments are no longer processed manually. Compliance is increasingly automated. The system is becoming less human and more programmable. This shift has profound consequences. When finance becomes software, rules are enforced by code. Bias decreases, but flexibility also disappears. There are no exceptions, no phone calls, no discretion. For consumers, this creates both opportunity and risk. Efficiency increases, costs fall, access expands, but errors become final. Appeals disappear. Understanding the system becomes essential. The most disruptive change, however, is happening at the level of money itself. The US dollar has always been digital behind the scenes, but now, digital dollars are leaving traditional banking rails entirely. Stablecoins, instant payment networks, and tokenized dollars move independently of legacy settlement systems. They operate 24/7, settle instantly, and integrate directly into software applications. This is not a replacement of the dollar. It is a modernization of how the dollar moves. Banks once controlled settlement speed. Now, settlement speed is defined by technology. This changes leverage. Institutions that adapt gain efficiency. Those that resist lose relevance. This is why large financial firms are investing heavily in blockchain infrastructure, digital custody, and programmable payments, even if they publicly downplay it. Behind the scenes, they understand the shift. The U.S. financial system is moving from trust-based intermediaries to verification-based systems. In the old model, you trusted institutions to process transactions fairly. In the new model, systems verify execution automatically. Trust becomes optional. Transparency becomes default. This transition is uncomfortable for regulators. Rules were designed around centralized control. Licensing, oversight, and enforcement assume identifiable intermediaries. Technology breaks this assumption. When systems are decentralized, enforcement must move to access points, exchanges, custodians, payment gateways, rather than the infrastructure itself. This creates tension. Innovation moves faster than regulation. Regulation reacts after damage occurs. The result is uncertainty, but uncertainty does not stop progress. It slows it temporarily. History shows this pattern clearly. The internet faced similar resistance. So did digital trading platforms. Each time, regulation eventually adapted. The question is not whether the U.S. financial system will change. It is who will be prepared when the change becomes unavoidable. This transition is already creating winners and losers. Those who understand automation, digital finance, and programmable systems gain leverage. They access better tools, faster systems, and global markets. Those who rely solely on traditional models face shrinking margins, higher costs, and reduced flexibility. This does not mean everyone must become a technologist. It means financial literacy now includes understanding how systems operate, not just how money is earned. Another major shift is the decoupling of income from location. Digital finance enables remote work, global payments, and decentralized earning. This undermines geographic wage structures that once defined American labor markets. For some, this creates opportunity. For others, it increases competition. The financial system is no longer designed only for domestic flow. It is becoming globally competitive by default. This pressures wages, pricing, and job security. At the same time, ownership models are evolving. Assets are becoming fractional, programmable, and liquid. Investment access is expanding. Barriers are lowering. But risk is also becoming more personal. There is no central authority guaranteeing outcomes. The U.S. financial system is transitioning from managed stability to adaptive volatility. This does not mean chaos. It means responsiveness. Systems adjust faster. Markets reprice instantly. Inefficiencies disappear quickly. Those who adapt early gain resilience. Those who ignore change experience it as shock. This is why understanding the direction of the system matters more than predicting short-term outcomes. The transformation is not about one technology or one policy. It is about a structural shift in how value moves, how decisions are enforced, and how trust is defined. And this leads to the most important question of all. What does this mean for the average American? Who benefits from this change? Who is exposed? And how should individuals position themselves financially as the system evolves? That is what we will address next. By now, one thing should be clear. The U.S. financial system is not collapsing. It is restructuring. And every restructuring creates winners and losers, not by chance but by position. The biggest mistake people make during systemic change is assuming neutrality. In reality, financial systems reward alignment. If you understand how the system is changing and position yourself accordingly, you gain leverage. If you don't, the system works against you, quietly and consistently. So the real question is not whether the system is changing. The question is where you stand inside it. Let's start with who benefits. The primary winners in the new U.S. financial system are those who own assets, not just income. Assets appreciate, generate yield, and adapt to inflation. Income alone does not. This is not new, but the gap is widening. In a system driven by automation, technology, and capital efficiency, money flows towards scalable systems. Businesses that can operate digitally, individuals who can earn remotely, and investors who understand modern financial tools gain disproportionate advantage. Another major group of winners are those who understand financial systems, not just financial products. Knowing how interest rates work matters. Understanding how inflation affects purchasing power matters. Knowing how debt compounds and when it can be strategically used matters. In the old system, mistakes were slower and often absorbed by institutions. In the new system, mistakes are immediate and personal. Education has become leverage. This is why financial literacy is no longer optional. It is not about becoming wealthy overnight. It is about avoiding structural disadvantage. Now let's talk about who struggles. The most exposed group in this transition is the debt-dependent middle class. This includes households relying heavily on credit cards, auto loans, adjustable-rate mortgages, and consumer debt to maintain living standards. As interest rates rise and liquidity tightens, debt becomes heavier. Monthly payments increase, refinancing options shrink. Small financial shocks become destabilizing. The system is no longer designed to absorb these shocks automatically. Another vulnerable group is those who rely entirely on fixed income without asset exposure. When inflation persists, fixed income loses real value. Purchasing power erodes quietly. This does not mean these individuals have failed. It means the system has shifted faster than traditional strategies. Employment itself is also changing. Automation and artificial intelligence are not eliminating jobs overnight, but they are redefining value. Repetitive tasks, administrative roles, and low-complexity work face pressure. Skills that cannot be automated. Strategic thinking, creativity, technical oversight become more valuable. Income stability now depends on adaptability. This is not pessimism. It is reality. The financial system rewards those who adjust early and penalizes rigidity. So how does the average American adapt? The first step is clarity. Understanding your cash flow, debt exposure, and asset allocation is essential. Many people operate financially on autopilot. In a stable system, this works. In a transitioning system, it doesn't. Awareness is protection. The second step is reducing fragility. This does not mean eliminating all risk. It means reducing exposure to sudden shocks. High-interest debt, minimal savings, and single-income dependency create fragility. Resilience comes from optionality, savings buffers, multiple income streams, transferable skills. The third step is participation, not speculation. New financial tools are emerging, digital platforms, automated investing, decentralized systems. The goal is not to chase trends, but to understand utility. Speculation is optional. Participation is inevitable. Those who refuse to engage with modern systems often find themselves excluded by default. The fourth step is long-term thinking. Short-term volatility is unavoidable during transition. Systems recalibrate. Markets adjust. Policies change. Reacting emotionally leads to poor decisions. Those who maintain a long-term framework focused on sustainability rather than speed gain stability. Finally, there is mindset. The old system rewarded predictability. The new system rewards adaptability. This does not mean abandoning caution. It means upgrading strategy. The U.S. financial system is becoming more transparent, more automated, and more competitive. Power is shifting from institutions to systems, from discretion to code, from trust to verification. This transition will not be comfortable for everyone, but it is not designed to be. It is designed to be efficient. The individuals who thrive will not be those who complain the loudest or speculate the hardest. They will be those who understand how the system works, accept that it is changing, and position themselves accordingly. Because the future of finance in the United States is not waiting. It is already here.